Hi, welcome to Decoding Your Taxes, Understanding Your Return to Build Wealth. My name is Aaron Rayum, and I'm the Director and Financial Planning here at the Financial Enhancement Group. Thank you so much for tuning in to our series. We are wrapping up a series of 8 videos that I've done over the course of the year. And so I'm just thankful for those of you that have joined and listened in as we've gone through some really good topics. And today we're going to focus on tax planning. On the screen, you can see I've been with FEG for over 10 years now. I'm a certified Kingdom advisor, and I have an emphasis on helping folks with stewardship so that they can plan in accordance to their Christian values. As I'm moving through some of these slides, I'm going to cover a few quickly, and then I'm going to go deep into a few different topics. As a disclaimer, Financial Enhancement Group is an SEC registered investment advisor. All that means is that we manage more than $100 million in assets at FEG. And in order to do so, we need a big team. FEG has been independently serving families for over 28 years, and we've got 4 offices here in central Indiana, as well as an office in Georgia and advisors out in California. So we've got a great team. We've been serving families for 28 years now. Currently, we take care of more than 1,200 families in over 30 states, and I'm just so blessed to do so. As you have watched, or if you're just joining into one of these for the first time, part of our process here at the Financial Enhancement Group is we go through what we call the 5 critical elements. And that's really just a financial journey that everyone takes, that everyone is on, whether you're planning for your life after work, maybe looking at tax planning, and then all the way to legacy planning. And as I mentioned, today is our focus on tax planning. And I'm very passionate about just financial planning and holistic financial planning in general, but tax planning and charitable gifting really are what help make a big impact in a lot of folks' lives. And we'll get into the difference of how to read a return, things that you should consider, maybe some misconceptions. But tax planning tells the story of your financial journey. It's more than just a form. It is a guide, and that guide allows us to make decisions based on information that we know. So the goals for today, we're going to understand how to read a tax return and just look beyond the numbers. We're going to look for opportunities, maybe to save dollars or just more importantly, some smarter decisions. And then look at aligning your tax plan with your long-term goals. And as you can see, I'll cover, 8 different topics here today. Probably going to spend the meat of it going through turning insight into action. So bullet point number 4, we're going to take a deep dive and look at different scenarios, and then wrap up with a little bit of stewardship. So as we move along, if you have any specific questions, please throw them in the chat and I will try to answer them as I can. If there's a specific question, drop them in the chat feature and I will try to answer those if I can. If during the presentation, if not, I will answer them at the end. So let's get started. Why your tax return matters is part of our 5 critical elements. This is one of the most important pieces. And it's more often, probably the way that I see it, probably misused or mistreated a little bit. Most major financial decisions show up on your tax return. If you have a mortgage, your mortgage interest will show up on your tax return. If you do charitable gifting, that'll show up on your tax return. If you have interest income from CDs or investments, that will show up on your tax return. If you have a business, if you have a net income, that will show up on your tax return. So your return isn't just about compliance to what the IRS says you need to do. It's actual financial roadmap to guide you along your journey. And I'm going to talk about why understanding the numbers can help lead to better choices. And then one thing that we hear often in the offices here at FEG is my CPA handles that. What should I do with it? And so we'll get into the difference. And I think I've mentioned this in the past, is there's a difference between tax planning and tax reporting. Tax planning is being proactive and getting things done before the end of the year. Tax reporting is what you have to report to the IRS in the previous year. So a lot of times when we work with folks, their response is, oh, I just let my CPA handle that. We actually work side by side with a lot of CPAs so that we have a collaborative relationship with the families we serve, so we can help guide them in tax efficient decision making. So let's start with making sense of the numbers. I'm not going to dig too deep into these, but your tax return, as I mentioned, tells a story. The first story it tells is your adjusted gross income. And so on here, it's probably pretty small to see, but generally down towards the bottom of your tax return, it takes all of what you have earned, whether it's through wages, whether it's through IRA distributions, pensions, Social Security, rental properties, business income, that all flows to your 1040, and it produces what's called your adjusted gross income. And so we want to know why that is important. Is it gives us the rules that we get to play with the IRS. Adjusted gross income, if you're still earning and want to contribute to Roth IRAs, if you earn above a certain amount of AGI, you can phase out of that adjusted gross income. If you're going to contribute to an IRA to get a tax deduction, there's phase outs on that as well. So that AGI really tells us the story, and it tells us how we can play with the IRS inside of their rules. Another thing to note is there's a major difference between a deduction and a tax credit. A tax deduction reduces the amount of your income that is subject to taxes. A tax credit actually reduces the amount of tax that you owe. And there's really two things with the tax deductions. Is you can either take the standard deduction, which most people do, over 90% of people take the standard deduction, or you can itemize. So if you're heavily charitably inclined, if you have mortgage interest, if your state and local taxes are above a certain amount, and you want to deduct some medical expenses, if all of those deductions add up more than the standard deduction, then you would actually itemize. And we'll talk through, and I can show you where that is on your tax return. So once we understand your adjusted gross income, we figure out where all of that income is coming from, then we get into the deductions, as I was talking about, and that flows down towards the bottom of your return. And we really want to know what's changed because of taxable income. As planners, that's what we're looking for. We want to know what your taxable income is going to be for the year. And so that is after your deduction or your itemizations, and then any sort of credits that you would get on your tax return. We're looking at what your taxable income is for the year. Now, for those of you that may not be as familiar with tax planning, just think of our tax system in the form of stair steps. We have a progressive tax system here in the United States. Everybody pays tax at certain levels. So this bottom, the green that you can see on the screen, that is the 10% tax bracket. We take a step up to that orange color. That's taking a 20% increase to a 12% marginal tax bracket. The next step goes to 22, all the way up to 37% on that pinkish color line up there. So we start at 10, move our way all the way to 37%. Really, the reason we want to know that is because it helps us with effective planning. As planners, we want to know, as you can see on the screen, where are your marginal brackets at? Where are your last dollars going to be taxed? And so there's another term that CPAs like to use and accountants. That is your effective rate. The effective tax rate is the average rate of tax you pay on each dollar. So if you have some income taxed at 10%, some taxed at 12, some taxed at 22, it will spit out your effective rate. And I'll be able to show and illustrate that when we look at some side-by-side comparisons. So effective is average, the average tax rate you pay. Marginal are those brackets, the 10, the 12, 22, all the way up to 37%. We want to know, as planners, where are your last dollars going to be taxed? So if you're looking through your return for the first time, things that you want to know. Do I itemize or take the standard deduction? What is my adjusted gross income? And ultimately, what does my taxable income boil down to be? Your taxable income shows us where you will fall in those marginal brackets. And in a few minutes, we'll get into the nitty gritty of how that looks. A couple of things, a few mistakes that we see that are common to avoid. Overlooking deductions that are tied to charitable gifting. So making sure that you are accounting for things that you have given throughout the year. Sometimes people forget about charities that they've given to and don't report it. A lot of times, though, that doesn't matter, because if you're taking your standard deduction and it's not high enough to itemize, the charitable gifting portion doesn't matter. It really matters when you're trying to figure out, okay, can I itemize versus taking the standard deduction? Making sure you're getting and taking care of HSA contributions. Those, as a family this year in 2025, you can contribute up to $8,550 in HSAs. And then if there's any sort of 529s or education type expenses, making sure those are accounted for. Those are just some things that we see where people have made contributions, maybe to a charitable organization, forget about it, and we're just trying to piece back what has been done for the gifting year. Failing to coordinate investment and tax strategies. That is one big thing that we see here is, working in conjunction together. And I'll go over that here in a few minutes when we do a side-by-side. But if you're putting a lot of capital gains on your tax return and you're in the 12% or higher marginal bracket, you start to pay capital gains tax. If you're in the 12% bracket or below, you don't pay federal capital gains tax. And so making sure those strategies are coordinated to make sure that the investments that you're using are tax efficient and you're not paying any unnecessary taxes is always a good thing. Another mistake is not updating withholdings after life changes. So when I say withholdings, that would be withholdings on any sort of tax forms. A lot of times we'll see folks that don't withhold on Social Security, and at the end of the year, they'll end up owing money, maybe not making an adjustment to a pension if you have one, and adding federal and state taxes to be withheld, taking out a distribution from a retirement account that hasn't been taxed, like a tax-deferred IRA, and not having withholdings done. Just make sure if you're having changes or making changes and it's anything associated with paying tax, make sure that there's enough taxes withheld, or if you're getting refunds, maybe we need to reduce that. Just make sure you pay attention as life changes that you're updating withholdings. Next is ignoring opportunities for Roth conversions or tax diversification. Not going to spend a lot of time here because I'll go through that in just a second. One of the biggest things that we see here at FEG is not planning for the passing of a spouse, where your marginal tax brackets get cut in half. I'll go through that as well, but that is a big mistake to avoid. And really where that kicks in is not paying attention to future required minimum distributions. For those of you that are not 73 today, when you turn 73, that's where the IRS forces you to start taking money out of your tax-deferred IRAs, 401ks, those types of things. And not planning for those future RMDs can create tax headaches in the future. Another one, thinking you'll be in a lower tax bracket in retirement. I've been doing this for about 20 years now, 11 of which have been with FEG. And a lot of the families that we see have been told, hey, save in a tax deferred bucket because when you get into retirement, you're going to be in a lower tax bracket. For some people, that's the case. For a lot of others, it's not. They have pension income that's coming in. There's rental income from rental properties. Got Social Security income and the future RMD income. A lot of times do not make people in a lower tax bracket, and we're having to plan around that as well. So thinking you'll be in a lower tax bracket in retirement's nice until it's not, when you have to pay attention to what planning opportunities to minimize taxes in the future. So what we're going to talk about in a little bit more detail is figuring out how to do Roth conversions, looking at opportunities to harvest losses, and then plan your contributions and distributions intentionally. I'm going to go through how we would walk a family through a tax planning scenario. So give me just a second to get my screen shared here, and we'll walk through this side by side and give you some things to think about. So take a sip of water. Tarna Jubilee, if you can give me a yes or a no that that's on the screen. It is not on mine. Okay, perfect. So meet family and household sample. They're just wonderful FEG families, so much so we had to call them family and household sample. Obviously a fictitious couple. But what we're walking through here is how we would plan for any sort of income this year, and then looking at things that we would want to do from a planning scenario in the future. So what we take a snapshot of is looking at everything that you tell us from a income standpoint. So samples, they are retired and currently living on a pension. Right now, they have roughly $1,000 a year coming in taxable interest. Up here, before I start to dive in, this is scenario one, looking at 2025. Scenario two, we'll look at what happens if we do a Roth conversion. And then scenario three, what happens when we have a passing of the spouse. But for now, I want to focus on scenario one. So taxable interest of dollars coming in from a savings account. They've got a $24,000 a year pension that has 100% survivor benefit on it. So if something happens to a spouse, they would continue to receive that income. Between the two of them, roughly $75,000 a year is coming in through Social Security. As you can see here, right now, they're only paying tax on roughly $31,000 of their Social Security income. The way Social Security works is the more dollars you make, the higher the taxation becomes. Up to 85% of Social Security benefits received can be taxed at a federal level. Here in the state of Indiana, you do not pay any sort of taxation on your Social Security. They also have some money coming in from capital gains from their portfolio. And once we look at all of that, what we can identify is where are they inside of their different brackets. So based on income here, their total income, they get a standard deduction of $34,700. They get the enhanced senior deduction. So for those of you that are watching that are over 65, and if your income's below a certain amount, you each get an additional $6,000 a year through the year 2028. And so that's being accounted for. Right now, based on their total income of Social Security being taxed and the enhanced senior deduction, that puts this couple in the 10% marginal tax bracket with an effective tax rate of 1.5%. So they are very, very, very tax efficient. But what you don't know about the samples is that they've done diligent saving over time. They've got a good amount of money invested in a regular brokerage account. And they also have a IRA that is worth $1.5 million currently that will be subject to future required minimum distributions. I'm going to go back, and knowing what we know, that they're in a 10% marginal bracket, their average tax rate is 1.5%. We know in the future that they will have to start taking required minimum distributions out of the account, and that's going to produce future taxation. So one of the things that we would suggest to our family here is let's look at potentially moving money from an IRA to a Roth IRA in the form of a conversion. So if we go back, still have that $1,000 of taxable interest, got $24,000 of pension income coming in. Social Security hasn't changed. We're still at $75,000. One big change, though, is the taxation of Social Security just went from $31,925 to roughly $63,000. So now we've hit that 85% max, and still have the capital gains of $12,000 coming in. So their total income just went from $68,925 to $140,750, and that's because we're looking at doing a $40,000 Roth conversion. And the reason we want to look at doing that is because we know RMDs are going to happen in the future. And so looking at this tax scenario, we have pushed them into the 12% tax bracket from a marginal standpoint, and their average tax rate just went from 1.5% to 6.5%. But what we were able to do is keep this couple in the 12% federal tax bracket by doing a $40,000 conversion. The top of that bracket is $96,950. And we've also been able to keep their capital gain tax at a 0% tax rate. So we were able to take $40,000, pay the tax today, convert it to a Roth so that they will never have to pay tax on those dollars in the future. And we still kept this family in a 12% marginal tax bracket. That's all in good. And the reason why we're doing that is because of what happens with the passing of a spouse. What I did just to illustrate this is kept the taxable interest the same. Fast forward a few years where required minimum distributions have to kick in because now they're age 73. The pension income didn't stop. Remember, there's still 100% survivor benefit, and you get to keep the higher of the two Social Securities. So the Social Security for one spouse is roughly $42,000 a year. So that income continues. The spouse with the lower of the two Social Securities loses that benefit and keeps the higher. And so looking at adding an additional $56,000, all this is taking the $1.5 million and adding the first year RMD of roughly 3.77% and getting an income that's going to have to hit the tax return, and it's roughly $56,000. The way RMDs work is the older you get, the higher the percentage goes. So by the time you're hitting your mid 80s, you're taking out somewhere between 6, 7, 8% of those IRA dollars that have to be subject to required minimum distributions. So one more tax report just to show the comparison here. As a reminder, a spouse has passed away. Incomes didn't stop except for one Social Security. And now this widow has went from an average rate of almost 6.5% up to a 14% average tax rate. And now they're in the 22% marginal bracket. And that's why proper planning is important. That's why looking at the conversions and doing those types of things helps us to pay attention to what's going to happen in the future. So a lot of stuff on making sure we're doing effective tax planning. These show you here where the brackets start to fill up. And so a reminder, your tax brackets get cut in half when you go from married filing jointly to a single filer. So that 10% bracket starts to fill up at $11,925. Then we get to that 12% bracket all the way up to $48,475. And the top of the 22% bracket's $103,350. So we're starting to push close to that. So we could potentially get into that next bracket, which is 24. We're not there yet with the widow, but that is the stuff that we try to avoid. And it's why tax planning and not just looking at your taxes year by year, but looking at taxes today and tomorrow allows us as advisors to help you really plan around those types of things. And so, again, very important to make sure we go through the exercise of proper tax planning. I wanted to break those down just so you have an understanding of how taxes work today and in the future. So, sorry, Lisa, I didn't know that it was blurred there. I apologize for that. I'm going to continue to move along the journey and continue to move at and look at year-end tax planning opportunities. Just as a reminder, and I said this earlier, take advantage of what's still within your control this year. Tax planning ends December 31st. Tax reporting starts next year. It really tells the story of what you did from a tax perspective the year prior. Some planning opportunities prior to year end. If you haven't done any sort of charitable gifting, you have the ability to do qualified charitable donations or qualified charitable distributions. Looking at donor advised funds are always a good thing to do from a planning perspective. Those usually work best if you had a large irregular income year and you're trying to offset some taxation. You can make large contributions to a donor advised fund to help offset some of that tax. And it's really an account that you can use for future gifting strategies. So making sure you're getting your year-end gifting done prior to December 31st is 100% an opportunity. Making sure your contributions are done. If you have the ability to contribute to a 401k, depending on income, there's caps on how much you can contribute. If there's some wiggle room there where you might be able to get a bonus year end and you're trying to decide, what to do with that bonus and you haven't fully funded your 401k, could be an opportunity to add some funds there. HSAs, those have to be done prior to year end. As I said earlier, $8,550 for a family for this year. And then 529 accounts, those need to be done here in the state of Indiana by December 31st. So just making sure you're getting those done prior to year end. One other thing to do is look at your brokerage accounts. A lot of times we can get into a position to where maybe we have some stocks inside of the portfolio or exchange traded funds or potentially mutual funds that do not have gains. You're able to, if they're losers in a portfolio and you no longer want to hold them, you can use some of those losses to offset your capital gains and those need to be done prior to year end. As you're doing that tax loss harvesting, you can make adjustments to your portfolio to rebalance as well. Do not forget to take your required minimum distributions. If you're over age 73 and you have to take a required minimum distribution, that needs to be done prior to December 31st, or else the IRS likes to tack on absorbent amounts of penalties. So just make sure that if you have to take required minimum distributions, you're taking those prior to year end. Moving on, I want to take a minute to focus right here, and it really goes back to going through the illustration of reviewing different types of tax returns in your overall situation. Really, you need to understand tax diversification. For most folks, there should be money that's in Roth bucket, which is tax-free. Traditional dollars are hard to avoid because that's where most people have saved inside of their 401ks, and likely tax deferred a lot of those dollars because Roth IRAs didn't start until 1997. And even at that point, it was controlled by your adjusted gross income and how much money you could make. But making sure you have tax diversification allows for you to be able to proactively and efficiently plan on distributions. And so if you have dollars in each one of those buckets, you can use that for your future planning. One thing that we are anticipating, and this is a prime example, is future tax law changes. So back in 2017, the Tax Cuts and Jobs Act was put in force in 2018, which lowered our marginal rates that I showed earlier. Well, those were set to go away or sunset at the end of this year, and we were going to go back to the old tax code that was in 2017, where that 12% bracket was 15, the 22 was 25, all the way up to 39.6. But that has been made permanent. However, over the course of the last 6 to 7 years, FEG has been proactively taking advantage of those lower tax brackets to move money into more of your efficient buckets like the Roth or your brokerage account. And so you have to anticipate future tax law changes, and that's what building tax diversification allows. And then making sure your tax strategy is aligned with your estate plan, retirement planning, and then generosity in the future. So all of this stuff that I've covered flows around planning, strategy, and stewardship because it moves around your taxes. As I opened, your tax return tells a story. I can look at most people's tax return and tell where dollars are going, and it just isn't a good way to show what things and how you're using those dollars. So let's turn it over to faith, stewardship, and taxes. Wise stewardship includes understanding the resources entrusted to us. I feel a calling to make sure that I'm helping people be biblically wise with their stewardship, whether that's from a gifting perspective or from a spending perspective. And you have to do that with integrity, diligence, and ultimately gratitude, because it's all really just a gift from God. And our time here is to make sure we're stewarding those assets well and using knowledge to make informed and faithful decisions. So if you're working with a good advisor, a good CPA, we should be able to help guide you in making those good decisions that will have a lasting kingdom impact. So next steps, what I want you to look at is, or at least ask yourself a question: when was the last time you reviewed your tax return from a planning standpoint? The way that I find people have done this in the past, as I've talked to hundreds and hundreds of people over the years, maybe thousands of people over the years, when we talk to them about their tax planning strategy, It's becoming more common today, I think, as more information's out there. But maybe a few years ago, the answer that I would get more often than not is, what strategy? I get all of my statements, I hand them to my CPA. They tell me how much I owe or how much of a refund that I get. And then I take it and I throw it in the drawer, and tax time comes next year and I do it all over again. So wash, rinse, repeat. So my question to you is, when was the last time you reviewed your tax return with a planning lens? Remember, tax planning is different than tax reporting. And so tax planning is proactive. What are you doing to possibly avoid, or not avoid, but reduce future required minimum distributions? Are you taking advantage of being able to use a QCD and give to a charity where you don't have to pay tax? So think about that. Think about where your tax planning has lied in the past, and think about things that I've talked about that you can proactively do in the future. What opportunities might be hidden in the numbers that you have? If I looked at your tax return, I should be able to tell you some different opportunities based on what the return tells me. So things that you want to consider there are things that I've already mentioned. If you're in that 12% federal tax bracket and you're not filling up all of the marginal bracket up to the 96,000, maybe you've got some gap there of 20 or 30,000. I would say it's probably wise, if you have IRA dollars, to convert that to Roth. But there's always opportunities that we can look at and use in our tax return. So what I want you to do is gather your most recent tax return. What I would have you do from there is go back to what I started with. Review your adjusted gross income, review your deductions, and make any sort of edits that you need to. So one thing that we do here from a planning standpoint is, let's say you still have mortgage interest, you're very charitably inclined, you have your state and local taxes that's currently capped at $10,000 a year. Let's say between those three items, that adds up to $30,000. Currently, that standard deduction is roughly $34,000. So we know we're bumping up against the standard deduction, but we're not there. What we traditionally have people do is do a double gift that year. So do 2 years worth of charitable contributions, so that you can take the itemization that year, and then the following year you would use your standard deduction. So you're getting a little bit better of a return if you're pushing close to being able to take that itemization versus standard deduction. And then schedule a planning conversation before year end. If you're doing this on your own, please reach out to a professional, because there's probably some opportunities that you're missing. I know here at FEG, we spend the last quarter of the year specifically focused on tax planning. So we do all of our family updates in the first 9 months and leave the last quarter for tax planning, just because it's such an important part of your financial journey. So as a reminder, couple key takeaways. Tax returns, a tool for insight, not just reporting. You can make small adjustments today that will lead to lasting future results, not just tomorrow, but even for future generations. Those Roth conversions, those dollars can pass to the next generation virtually tax-free. And then knowledge brings clarity, and clarity supports stewardship. And I just want to thank all of you so much that have stayed with us this eight times that we've done this year. If you have not watched all of our videos, you can go back and click on them. They are on YouTube. You can go to our website and find them. As just a reminder, you don't need to love taxes. You just need to understand what they reveal about your journey. If this is something that you have questions about, or you want to know more information, please reach out to us, 800-928-4001. You can schedule a complimentary next steps meeting where one of the advisors on our team will give you things to think about. And if we decide to partner together, we will give you a written plan and what FEG will do for you. Scan that QR code on the screen that will link to the advisor calendar. We're more than happy to help you make sure you are moving along the correct financial journey. Thank you so much for watching. You all have a happy Thanksgiving and just have a blessed day. I appreciate you all very, very much. Have a wonderful day.